We're thrilled to have you all here with us. And the topic for tonight's conversation is a very important one for the nation's capital markets. It's an even more important one, I think, for those of us here in Silicon Valley, because the topic is the rise of the controlled corporation, and the controlled corporation is on the rise in Silicon Valley, much more so, I think, than it is any place else in the rest of the world, except China, all right? So I think we're going to be seeing a lot of other controlled corporations coming out of China. And by the way, the phrase controlled corporation has dual meanings, if I may use the word dual, when you think about Chinese corporations for a wide variety of reasons. We are exceedingly fortunate to have with us this evening a truly expert panel that's going to be able to address this very important and complex issue. Let me begin with our superstar, the Honorable Jack Jacobs, former Justice of the Delaware Supreme Court. I've known Jack probably for more than 20 years, and let me tell you, one of the great things about Jack, the longer you know him, the better he gets. All right, and no, really, and I started out as a huge Jack Jacobs fan, and it's only getting bigger. It's only getting better. Ann Sheehan, I've known, gosh, for about as long as I've known Jack, and Ann has much in common with Jack because, again, Ann really, really grows on you, and you really, in a good way, Ann, in a good way, and I think it's fair to say that I've probably learned more about, or as much, I don't want to get overly effusive, about the real practicalities of how corporate governance works and how really intelligent investors who have to make decisions for tens of billions of dollars of investment and have to vote proxies at thousands and thousands of corporations, when I want to know what does a rational person in that situation actually think and how do you go about the problem, Ann's my first call. All right, so here's an issue. What are investors thinking about this, and what are they doing, and why? And very often the question is, why aren't you doing something about it, as opposed to what is it that you're doing and why are you doing that? Tad Freeze joins us. He's a corporate partner and vice chairman of the Global Corporate Department at Latham & Watkins. He's representing high-tech companies, investment banks, other public and private companies, and he's in the middle of the debate of how do we set up a dual-class structure, how do we arrange voting rights and corporate governance rights here in Silicon Valley and elsewhere around the world. Thank you very much for joining us. And last but not least, and certainly not least, we have our moderator tonight, Dan Siciliano. Dan is the director of the Rock Center for Corporate Governance here at Stanford Law School and also at Stanford Business School. Dan is one of the bright young lights in the area of corporate governance. But to me now, Dan, virtually everybody is a young light. Is one of the very bright young lights in this area. He is, I'll use a phrase in two terms, he is really a rock upon which we've built the Corporate Governance Center here at Stanford, doing a great deal with our executive education program. And in Silicon Valley, it's very important to know who teaches the venture capital course, all right, at Stanford Law School. And Dan is the guy that teaches our venture capital course. And I keep explaining that teaching venture capital, it's something I used to do until Dan came along and I said, oh, he can do this. This is no problem. Teaching venture capital at Stanford is a little bit like teaching Catholic theology at the Vatican, all right? You want to make sure you're doing it right, and Dan's our guy who's doing it right. And with that, by way of introduction, ladies and gentlemen, I give you Dan and the rest of the team. Thank you.
Great. Thank you, Joe. Well, we have to get going because Tad's visa for the Stanford campus expires soon. He graduated from Harvard Law School and Cal, so he kind of got both wrong, but that's okay. He's allowed here till 7:05.
Sorry, you're getting close to home. I went to that law school too.
Well, I wasn't going to tease that out in front of you, but now we know. So I'm outnumbered, actually, from the entire left side here. But thanks for joining us this evening. As Joe said, you really, really wanted to be here, so we appreciate that. We're going to go ahead and do just a open-ended conversation with some questions that we highlighted, and then, as is our custom, we'll try to leave at least the last 20 or 25 minutes to a variety of questions that maybe you'll ask. And I mentioned now, and I'll mention again, when you do ask a question, please stand up and come to one of the standing mics so we can capture it on video. I know a lot of people had a hard time choosing between which event to be at, and they're going to want to watch this video afterwards. So the idea of a controlled corporation obviously is a term of art in corporate governance, but for our purposes, we're mainly talking today about dual-class share-controlled corporations, but we aren't going to leave out the idea of companies that have a single class of shares and have control features where perhaps a single entity or a single person owns a substantial percentage of those shares. As a practical kind of benchmark, you say about 30% or higher would make someone a controlled corporation. But we're going to discuss the full trend, and I wanted to, right before we started, just throw out a few numbers. There's some great studies that are out there that kind of take a snapshot of what the landscape looks like in terms of U.S. controlled corporations, but I think it is worth saying that in terms of evaluating the performance relative to controlled or not controlled, dual class, not dual class, the jury is still out. There was a lot of academic work done in 2002 to 2004. There's obviously a resurgence of interest starting several years ago, and there's still a lot of work being done. If you want a quick kind of snapshot refresher, the IRRC had a good study that came out at the end of 2012. It's more of a summary study worth looking at. So from that, I'll borrow some of their data. Out of the S&P 1500, as of the end of 2012, there were 114 controlled firms. In 2002, to give you perspective, there were 87. Now there are more than 120. So it's worth kind of tracking the fact that this is an increasing phenomena. We have more controlled firms. Of those firms, though, only, as of right now, 35 are controlled firms with a single class of stock. So the growth has largely been with the phenomenon of dual class shares. And then there are kind of controlled firms that fall somewhere in the middle. We say Alibaba and we think dual class shares. We might get to it, but it's actually a little bit more complicated than that. And so we'll include those companies as well, obviously. And we aren't particularly commenting on foreign countries or companies outside the United States, though we might get to that because that in many jurisdictions is the dominant form of ownership in terms of controlled firms. So with that, I think we're going to do the first question to Anne, because you've been out front on this topic quite a bit, and you're on record, I think, as identifying the one share, one vote concept as a fundamental to institutional shareholder views of corporate governance. And I want to ask, if this is a precept of good governance, why is that? Like, what is the reasoning behind saying one share, one vote is good governance? And what does, like, CalSTRS and maybe even CalPERS, what do they say about that?
Are these on?
They are. Yeah, okay. You just need to lean a little towards it.
Okay. Thanks, Dan, and thanks for inviting me, and thank you all for being here. In terms of, I don't know how much you all know about CalSTRS, about $188 billion assets under management. We are the public pension fund for California K-12 and community college teachers. And the large majority of our holdings are in public equities, about 55%, so 100 billion or so. So my role there is Director of Corporate Governance. So as Dan was saying, I vote the proxies, I do the engagements with the companies, I also hire activist managers who take positions in companies with the idea of improving the performance of the company through better governance, through better capital allocation. And one of our fundamental precepts for our governance principles is one share, one vote, because we feel that the economic interest should be equal to the voting interest in the companies. If I own 10%, I should have 10% of the vote. If I own 20%, 20%. And I think the concern of the controlled corporation is that for a company who's gone to the public markets to ask for capital from other individuals and then, in our view, disenfranchise those providers of capital is not really a good governance issue. So that is really our fundamental premise. Now, there are companies, and we were talking about this on the outside, Berkshire Hathaway has two classes of stock, but the voting rights are equal to the economic proportionality of your ownership interest. So, and the reason he did that is he doesn't like stock splits, and so as it kept growing, and some of the shareholders wanted some liquidity out of their holdings, their only choice was to sell all of it. So they were able to they were issued B shares, which were less expensive, and they can have access to liquidity without having to sell all of that. So, but we are owners in Berkshire Hathaway, as we are owners in everything. We're heavily indexed, And so many of these companies, and I think we'll get into this, are in the index, so I don't have a choice. I mean, we are 2/3 index, so if I buy the index, I buy these companies with all of their governance shortcomings that we see in this one, and our goal is to really engage these companies and have a discussion with them about the disparate voting rights and the concern that we see over the long run that these companies have.
I'm going to tease out the conflict between investment managers and corporate governance professionals more a little later, but this is open to anybody, and Ann, you can take your first shot at it maybe. Do returns trump this at some level? So you might have this principle, but then you end up investing in these companies no matter what, and if they have great returns, are you going to kind of back off a little, or how's that work?
Some of these companies have had very good returns, and I would say that returns, our goal is to have enough money to pay when some teacher retires in South Central Los Angeles to pay her or his pension. So returns are very important to us. But we also look at returns and performance over the long run. We are inherently universal owners. As long as there are teachers in the state of California, we are going to be invested in the markets. So while Google or Facebook may have great returns now, is it going to be the same in 20 years, in 50 years? So we take a very long, big picture of these governance issues. So do I ignore it because Google may be performing now? No, not necessarily. I appreciate the fact that they are performing well. Google and many of these are large holdings in our portfolio, but we nonetheless continue to talk to them about some of the concerns that we have, because our issue is when the company perhaps trips and falls and the shareholders want to come and make a change, many of them, it's at that point in time that they wake up and realize, I can't do anything about it because my economic interest is not proportional to my voting interest in having a sway over making changes at the company. So while we like the returns and we like the performance, we take the long view of these investments in our portfolio.
Anyone else want to chime in on that? Maybe.
And do you think that that's universal? Like if you talk to some of your colleagues in non-index funds, I mean, I'll tell you at any point in time, I probably have between 15 and 20 public company clients, and I have no statistics other than my limited sampling, but I will tell you the underperforming clients are far more likely, in my experience, to get 14A proposals from activist investors or even just institutional investors than the companies that have had at least a recent history of strong stock performance.
Oh, absolutely. And one of the things when we do proposals, many times for unrelated to this issue, but perhaps some other ones, and this year there are a number of, say, proxy access proposals. Some of them are underperforming companies that my colleagues will focus on. So that certainly is, when we're looking at shareholder proposals, can be a threshold. But on this issue, my point to Dan was I don't ignore the fact that a company may be a good performer and still want to talk to them about the concerns we have over the long run of dual class voting.
So one of the things, Ann, that you didn't say, and I think it's important, is you didn't say that you worry that these controlled corporations will somehow enable management to pillage or pilfer resources to their own advantage in a way that's different from, say, non-controlled corporations. Instead, you focused, and I know we'll come back to it again and again, on this future risk of making change when things go off the rails.
Well, but I think that is another, there are many issues.
So is that an issue? I guess because I'm going to turn to Judge Jacobs, but I want you to say, do you worry about that, and how much do you worry about that? Because I want to address our legal framework in the United States, where at least in theory, we have a lot of protections in place for minority shareholders. But is that something that you actively worry about next to this issue of like succession or control later with performance lags?
It is an issue, and if we see something troubling at a company about perhaps a capital allocation issue or some structural issue, that absolutely is a concern. But from a bigger picture perspective, we see this issue over the long run because many of these companies are going to be in our portfolio for a long time.
Okay. So, Judge Jacobs, do you mind maybe addressing this idea of the fact that, maybe I'm interested in your opinion. Do we have, in fact, in place a robust system that seems to reasonably protect the minority investors? And is it working as well as it did when it was single class control versus dual class, or does that even have anything to do with it?
Well, I'll do my best to answer that question, but just a couple of preliminary remarks. Number one, while I appreciate being referred to by my former title, I'm not a judge anymore. I retired from that effective last July, so I'm just another lawyer. Secondly, I want to thank Professor Grunfest for those wonderful remarks he made. After those, the only direction I can go is down. But I will say that, I'm glad that it took only 20 years for him to recognize my inherent virtues. To answer your question, part of the problem with the question is, what phenomenon are we really talking about? There are two facts that came out in Dan's opening remarks, and they were educational to me. Number one, that we have a sharp rise in the number of Fortune 500 companies that are controlled, whether with one class or dual class, that is built-in structural controls. And of that number, 70% are structural dual class. That's new. I don't know why that's happened, but the question is, the question you're asking us is, does that new phenomenon create a new problem from a legal standpoint? And my answer to that is, I don't think so. We deal with, we being the Delaware courts, but I submit the courts of all states deal with controlled corporations all the time. Almost every multinational corporation and most national corporations have subsidiaries either that are set up to do business in a particular country or are set up to run a particular segment of the overall corporation's business, and they are controlled. Some of them are 100% owned. Many of them are public companies and are anywhere from 51% over controlled. So we deal with that all the time. Much less so with the structural dual class. My message is very simple, and that's this. Number one, under Delaware law, and I don't know the law to be any different elsewhere, but I stand to be corrected. There is no bar that precludes an investor from investing in a controlled corporation as long as the material facts are disclosed before the investment is made. As long as you are voluntarily making an educated, informed choice, God bless, you can buy into whatever company you want. The question then becomes, if the controllers start misusing their control, is there a robust system to remedy that? The answer is yes. In Delaware, we have what's called the entire fairness standard, which is one of the most difficult standards to satisfy if you have a controller basically self-dealing with the assets of the corporation to the detriment of the minority stockholders. There's been we've been dealing with that problem for generations, and we still do. Although litigation is very expensive, and there are problems with the expense of litigating entire fairness cases, I don't know anybody who would say that it's not an adequate remedy once you are able to carry that litigation through either to a judgment or a settlement. When it comes to the dual class issues, the only experience that I've had with it is when the dual class was used as a defense against a takeover. You get blank check preferred. Somebody's threatens to do a proxy contest, and all of a sudden the board issues a new blank check preferred that has super voting rights, and they put it in the hands of somebody. There's a robust system to deal with that because it's used as a takeover defense. Apart from that, there's at least in my experience, the law doesn't distinguish between corporations that are controlled by virtue of having structural dual class shares and those that just have a controller that happens to own a majority of the single class of shares.
Great, thanks. Tad, this caused me to maybe ask you a follow-up, which maybe has a couple of parts.
Yep.
You're representing lots of private companies that are planning to go public and or tapping the public markets.
Yep.
So are they talking a lot? I mean, so what's the conversation like inside the company in anticipation of this? Do companies really want this? Do they discuss the different pros and cons? How does it actually play out?
It really depends, right? So for a Silicon Valley-based company where the majority stockholders at the time of the IPO are venture capitalists, you don't tend to have the conversation very much, right? The VCs are not particularly interested in maintaining control post-IPO. To them, this is an economic decision, it's an investment. So where the conversation happens is where you have founders, or early CEOs that together hold a meaningful percentage of the stock. And for companies in the tech space that are hot companies, it's a conversation that's had on most IPOs. You still hear about it a lot. As I think I was mentioning to you earlier, the one thing that has shifted in recent years, we'll say post-Facebook, is the bankers really push back on it. And I didn't used to see that as much. The bankers were much more willing for a hot company to really do whatever the hot company wanted. In this day and age, I think that's changed a lot. I had a very, very high-profile IPO this last year where the founders were going to have close to a majority, even on an economic and voting basis, without a super voting stock. And they talked a lot about it, and the banks really pushed them.
Why?
The banks, well, and you got to say how cynical you want to be. I mean, the banks certainly want to help the company have an IPO that is executed as well and as smoothly as possible. The pitch the banks make to the company is, you have 20, 30 minutes with Ann when you meet with her on the road. You do not want to spend 15 of it explaining how your supermajority voting class works. And so I think the banks, at the end of the day, are looking to make the case for an ease of use and a smooth execution argument. Look, at some level, they want to make their jobs as easy as possible too. So the cynical take would be they're just looking to sell this as easily as possible and don't want to have to try to educate an institutional investor class about this, and so they try to avoid it. It's probably somewhere in between, the reality. I think there's no question you will end up spending time on the road talking about it if you're something short of a Facebook or a Google. And it comes up with all sorts of companies. Companies, I had one where it was a $100 million IPO. a pretty small IPO. And the founders were really bent on it. We had conversation after conversation. It was in our S1 until, 2 days before filing when they finally conceded to not do it. When, the market, as we all know, in the recent years, the market's had its ups and downs, and it was having a little bit of a down, and it was just enough to convince the founders they didn't want to risk the execution of their IPO, and so it pulled. So it's a conversation being had, but I do think you're seeing, more bankers, which in part is driven by folks like Ann being very active, during the IPO process and post-IPO process, spending time talking about it, suggesting that perhaps it's not the best governance, and maybe there will be a valuation hit. And obviously, folks don't like to hear that. So
I think in a few minutes we'll come back to this dynamic where it's kind of a hotness power factor that empowers the company to be able to get this done if that's what the founders want. But before we do that, I'm curious about why maybe, and maybe we do see it, but why we don't see more creativity in the deployment of certain factors of control on behalf of founders that want more control. It seems very binary at the moment, right? You're either, as you just described, there's either going to be dual class share structure or suddenly there's not. And yet there have been discussions over the years that vary from, time-based, you have dual class, but it eventually, time lapses all the way to performance-based where you get to keep rights if the performance is outperforming, but that eventually goes away. We don't see a lot of that, or at least it appears that we don't see a lot of that. Why is that? Or do you think we'll see more of it soon? And anybody could answer that, but I know, Tad, you're talking to folks, and Ann, you see a lot.
Why don't you go ahead?
Yeah, I would say it's probably a pretty similar answer to my last one, which is I think the bankers would really worry about something like that, right? So if you have a straight, class of stock that has 10x the votes of the common, that's not terribly hard to explain, right? So you meet with an investor, and the answer is, as long as I've got more than 5% of this company, I'm going to control it. That's a pretty quick answer. If it gets into, aggregate IRR over this many years, and I've got charts, and
Okay.
I think you can really get bogged down. I think that really spooks the bankers. I think you could see some simple things, like I think we saw something with Zillow, right, where it's as long as the founder is alive or hasn't sold the shares, something that's maybe takes a step that way, you start getting into performance-based metrics and kind of other complicated phase-out formulas, and I think the bankers will worry about the amount of time spent in the roadshow talking about it.
Yeah, I would say it's too complicated if you're out on the road trying to sell it. It's too complicated to sell to your investors, and especially if you're a small company, that you're only raising a couple $100 million. People are like, oh, this is too confusing to figure out.
I'll invest in the next one.
Yeah, it's like so we have seen some variations on this, and the Zillow is the right one. So when the owner founder moves on, his shares convert to one share, one vote type of thing. But there are some that, like Facebook, it sort of goes to the grave with him with the shares, so it doesn't. And those are the ones that are somewhat concerning to us, because it is many of them are technology companies that we've seen doing this, here in the Valley. But there are many big technology companies that have not done this, that had faith in their products, that had faith in the market. The Apples, the Microsoft, and said, we're going to do one share of one vote and go out like the other, mature companies out on the markets and access the capital. And we have faith in our shareholders in terms of that. And we have faith in our own ability to influence and work with our shareholders to run the operation of the company. So it isn't only tech companies this is not the only way that they're going to go. There are many that go with the traditional model.
I refer to you as the panelist formerly known as Judge Jacobs.
Well, I may be the only one at the table that feels like he's missing something, but the one of the elements of this discussion that really hasn't been stressed, and let me ask it point blank, is why are we getting this meteoric rise in the number of controlled companies that are going public, and of those 70% being embedded structures? Is it because of fear of the activist investor phenomenon? That is it out of a desire to preserve the business plan inviolate that was in effect before the moment before the company went public? And if that's the case, why isn't that a good argument that could be made by the bankers to the public that they're seeking to sell the shares to, particularly if you have a more flexible kind of dual class structure where, as long as the founders hold the control stock, it remains control stock, but as soon as they're out of the picture, that stock reverts to one share, one vote stock. That's a pretty good argument.
So we don't have the benefit of, say, for example, having Scott Cooper here from Andreessen Horowitz, who has a very clear vision as to what they call their version of the founder's dilemma and why control is an issue. But let me throw out an idea that answers that partially, and it's more about culture almost in Silicon Valley, and see if it resonates, and maybe it doesn't. And I would suggest that particularly successful venture-funded companies have, throughout their life cycle, a relatively adverse relationship at certain stages in particular with their investors. There is an anxiety on the part of entrepreneurs about control, sustaining control, and this permeates their entire view over time of what investors mean. And so when they arrive at a point where they are ready to tap the public markets, they may or may not be particularly sophisticated about what that means as a change in type, right? But I would suggest that many entrepreneurs arrive at that stage highly skeptical about the trustworthiness of shareholders generally, even if they don't articulate it as specifically as worries about activist investors or otherwise.
But the explanation that you've given, I think, would have been just as true 10 years ago as it is now, and yet we have this rise in the number of structural dual-class companies.
And I think that might be because of the power of high-velocity unicorn private companies. Unicorn meaning they've passed the billion-dollar valuation, they're growing very, very quickly. There is extraordinary demand by Ann's investment managers and other investment managers to get in on those IPOs at any cost. They're desperately afraid of missing it, and that dynamic empowers TAD's clients to say, you know what, I want this. And if they have that power and velocity, it seems like they can be more likely to pull it off. So Tad, what do you think? You look sort of skeptical. Maybe is this you're on the ground doing this? Is this the dynamic that you see, or is it something
part
else?
of it? It's part of it. I have a serial entrepreneur client who, even with VCs, will only accept investments from VCs that let him maintain control, even if he has a minority economic interest. So there's no question that some of that mentality exists. I think we've probably gone on.
And he must be hot stuff to be able to pull that off, right?
You know what? Yes, exactly.
Okay,
right. So he's 28.
He
has a big hit, and he's got a group of VCs that now are like, you made us a lot of money. We're willing to follow you. And that there is no question that line of thinking follows a lot of this, right? And a lot of these companies, to your point, have already crossed the $1 billion threshold before they're public, right? And the thinking of the founders as well. We've had remarkable success without significant shareholder input to date. Leave us alone. I mean, there's no question that's part of it. I think part of it also, though, has gone beyond that, right? Which is it's now out there, so it's something everyone just thinks about. When you're going to do your IPO, if you're a founder and you have a very large stake, it's like, well, Zuckerberg got this. Why can't I have this? Someone needs to tell me why I'm different, and that can be an awkward conversation for a banker.
Well, and they're not all Mark Zuckerberg.
That's right.
That is.
But they
the
think
issue.
they are. Yeah.
Right, exactly, and they hope.
This is where you get to say,
and
"I
they
knew Mark
want-
Zuckerberg,"
Yeah,
and you're
exactly.
no Mark Zuckerberg.
Exactly. That's what Tad gets to say to them in terms of that. But I also think, to your point, the hype around, and you look at the Alibaba. Now, your average person out, they're not even. You get a contract with an entity in the Cayman Islands, so that you can deal with it. You don't even own it, and yet the influence and the hype around the Alibaba IPO was amazing in terms of that. And I just think, boy, I hope nothing goes wrong with that. If the Chinese government decides they don't like him, which, he's doing great things for China, that company could be done. And the shareholders would have absolutely no say. But I think because of the hype in the market and because of what's happened with many of these tech companies, people have begun to think this is acceptable behavior. And I guess the issue is, okay, well, as our parents used to say, if everybody does it, does that make it right? And for us, as sort of the long term, it's like, we're going to look back and say, was this good or was it not good? For some instances, it works for Facebook. It still is, are they still growing and can they sustain the type of growth that they have now? We don't know yet. And so I think they are doing it, but for a long-term shareholder like us, it's, the jury is still a bit out on this, on the long-term experiment.
How did that conversation go?
Own it because it's in the index. And so I can't create a separate index for CalSTRS. It would be very costly for us to do, X dual class. Well, not even dual class, the control and share. It would be very expensive. So we've got to buy the market and sit down and talk to them about long-term governance of this, because the performance can go like this, and everybody gives them a free ride when the performance is going like that. But when the performance is going like that and everybody goes, oh, I can't do anything about it, that's when the shareholders, now, can they sue? Yes, under some, but that's not our preferred course of action. It's not a very economic way to do it. I'd rather do some other things and talk to them about some changes. One of the things that I haven't seen is some of these, and this goes to your point, some of these fee shifting bylaws and whether they could do something with controlled share and fee shifting, and that could really affect the rights of shareholders. Perhaps to sue. So I don't know, because you've got a lot of smart lawyers out there, like the two next to me, who can figure out various ways that companies can keep shareholders at bay through legal mechanisms. And as many smart lawyers, there may be different structures that they can do in this regard.
I think Ann has accused you of something, but I'm not quite sure
Not
what.
these two.
So, Ann, how did that conversation go, though, with your investment managers? You mentioned they're in the index, though you had to put in the index, but I would suggest that you, or if not you and CalSTRS, your peers, the governance professionals, when talking to the investment professionals in their organizations, even if they could magically wave a wand and cautiously remove Alibaba from the index, I suspect the investment professionals would say, no. We absolutely have to own some of that. And so did you have conversations with your investment professionals, and what did they say about Alibaba, for example?
On Alibaba, I didn't talk to our global equity folks about Alibaba, but just watching all of the circus around Alibaba, it was just amazing to me in terms of what the impact would be and whether people really understood this. I know a lot of people who bought it, held it until it run up and then exited because they knew in the long run, they weren't quite sure how this structure is going to work, but they were going to ride the wave as long as everybody else was going to ride the wave.
And if you do that enough, you're considered a successful investment professional.
Yeah. But for many of them, they're a short hold manager. They're not, they're trading in and out, and they're active traders.
Sure.
And that's fine if that's what their goal is. Ours is not to spend the day with our 105 billion actively trading that and buying stocks and going in and out of the market.
You make some bank very happy, by the way.
We would.
But,
Somebody would
yeah.
be making the,
Yeah.
yes, exactly. The banks would be very happy in terms of that, but that is not how we have chosen to manage our portfolio. We have made a conscious decision to be heavily indexed, and that is the decision that the board has in terms of the most economical way to manage $188 billion. You can't, I mean, it is a lot of money, but it's like moving a cruise ship in terms of how difficult it is to try and redeploy money to something else. And the trading costs of that are very expensive in the long run. So we have to make a decision about the way we do it. Now, we are investors in many of these venture capital firms down here. So I talk to our private asset class folks about when these companies go public and sitting down. So we're a little bit pregnant on this because we're on both sides of this. But the majority of our holdings are in the public equity classes. So we do focus on that.
Jack, you looked like you wanted to chime in there.
Well, this is maybe another example of my missing something. But what I'm hearing is that, and I'm not an investment professional, there's something about structural dual-class companies that have gone public that creates an investment problem for investors that are index funds. And Ann was trying to describe that. All right. I'm not quite sure that I understand, all the ramifications of the problem, but I accept that there is a problem. However, doesn't CalSTRS and the other index funds have the very same problem with single class share companies that happen to have a controller?
Well, anything that's in the
different?
index, we buy. So if it's a company that has dual class with disparate voting rights or a controlling shareholder, if it's in the index, we have exposure to it. So if that's
So there's no difference, right?
No, not from the ownership perspective.
Or from the perspective of making a
Governance.
decision to invest
Right.
in
If
these
it's in the
portfolio
index.
companies.
So, and if work, really, let's imagine great empirical work, perhaps funded by the Rock Center, perhaps not, that comes out and it demonstrates in a really robust, convincing way that both in the short run and in the long run, some subset of controlled corporations, as it happens, the 2012 study showed that single-class controlled corporations actually outperformed in the prior 10 years relative to their peer set. That probably isn't true anymore as it happens, but it just happened to show that. But if you were convinced that dual-class share structure companies performed better over time, let us imagine not the Facebook legacy, pass it on, but it expires with the founder, perhaps more the Zillow. Mm-hmm. Would your principled position shift? Because I'm giving you a huge assumption. Let's admit that there's no evidence of this yet, but if the performance issue, even in the long run, were simply taken off the table as a risk/problem, you just have the same risk/problem as you would with any other company, would that change the perspective?
Well,
maybe?
I mean, perhaps, but I would have to, it's a big assumption because you're talking, what'd you say, 120 out of 1,500 companies, the performance over the long run.
There's so many assumptions that go into that model.
Sure. It's hard to give an absolute yes or no in terms of that. So.
Okay, no, that's a fair answer.
Yeah.
I guess part of what and we'll switch to open-ended questions in a second. Part of what I'm trying to get at is there is clearly this tension between the investment professionals and the corporate governance professionals. And I'm curious if you see a way in which that might eventually be resolved. Because you could, on the index, you could engineer your investment in the index and just say we're not going to give our capital to these types of companies. And that might be costly at first, but if you all got together to do that, you could do that. But I bet your investment professionals won't let you do that, if I had to guess.
Many of the portfolio managers would not, because they they are looking at only performance as
Right.
the measurement of their success. So I get that. That's an economic decision that they make. For us, and there's always a tension between the governance folks in a fund, the corporate governance who vote the proxies, have to do the long engagements, and the portfolio managers, whether it's at CalSTRS or BlackRock or whomever, any of the institutional investors. There is this push-pull where we have to try and work together because the portfolio managers are judged solely on the performance of that stock. And does it really matter? I mean, can you go all the way up to, not doing anything illegal to affect the performance of it, and it's fine. For us, in terms of some of the governance issue, which to us is the process in the long run of, is it a well-governed corporation? Are the board of directors acting in our best fiduciary long-term interests as they're making decisions? And it's only about the short-term quarterly performance. So there is that tension, and we're always going through that tension in terms of that. So I think that would exist whether it's dual class or whatever. So we have that discussion about the very fundamentals of why we advocate for good corporate governance principles, and one of them is one share, one vote, or economic, I guess what I would say is, economic voting interest proportional to your ownership.
So last question I'll ask, and then we'll switch it to open questions. And maybe it's for each of you, in part. If you did want to curtail dual class share structure or controlled structures, how would you do that? So assuming you did want to curtail it, and I think your position is that you probably do, all things equal. What would you do to affect that change?
One of the things that the Zillow model, if I had to choose a model, that would be the one that I get why the founder owner, he or she, invented the company, the product, whatever, the technology, they understand it, and as they go to the market, they want to make sure the company gets set up and the management decisions and the strategy is executed pursuant to the idea that they had. So I get that. So if they insist on doing it, at some point, what we've said is you need to sort of graduate to a mature governance structure like many other companies that are listed on the index or on the exchanges. That's what we've said to them. That I get it in terms of that, and we see both in the private equity space and the venture capital in terms of the board positions that they take, so they can control it in that regard for the decisions. So whether it's a stock class or the board or whomever, at some point they need to go through this evolution and this maturation process to really, if you're accessing the public markets and asking for capital, what should be the standards or the norms of behavior for that company that are sort of accepted in the marketplace? I hear from many companies that are not technology, aren't dual class, they're as offended by this as our group is in terms of that. Some of these large companies that have one share, one vote, and they're like, why don't they act like the rest of us do? Now, they may be jealous that they didn't think about it. I didn't ask them that.
Tad or Jack, anything?
Yeah, I mean, from my perspective, the only way this changed, it's not really a legal issue, I think, as Jack was touching on earlier. From our perspective, when a client comes to me and says, should we have a dual class structure or not? From a legal perspective, I'll tell them some of the law around being a controlling stockholder, and to Jack's point, some of, the entire fairness issues you may face if you embark on certain sorts of transactions, but the reality is it's a disclosure issue, right? And you tell me one way or the other, whatever you tell me, I'm going to disclose properly in the S1, and then it's really for the investors to decide. So I think the only way this changes is if there is a groundswell on the investor side and they decide, we're not going to invest in these companies, or we're going to insist on a valuation haircut, or something along those lines. I think otherwise, the hot IPOs are always going, to your point, the investment managers are going to want in, and absent something broader from the investment community, I think you'll continue to see that.
Well, I'll echo what Ted said. Theoretically, there might be a legal fix. At the federal level, theoretically, Congress could amend the 34 Act to provide that there will be only one class of shares. And it'll be common shares, and it'll be one share, one vote. Or they can provide that whatever classes of shares have voting power, there can be no more than one vote per share. They could do that. Will it happen? No. It would take a huge groundswell of political push to get the Congress, particularly this Congress, to do anything that radical. And at the state level, the same is true. Delaware could amend its statute essentially to provide the same thing. But that would basically be turning 150 years of law upside down, and there was, it would change the whole system. Is that going to happen politically? No. So I don't think that we're really realistically talking about a legal fix, if there's a need for a fix.
Yeah, and I don't think you're going to see it out of the courts either. I mean, as I mentioned to you guys, I had lunch with Leo Strine last week, who's on a successor to Jack on the Delaware Supreme Court, and his viewpoint was clearly solidly caveat emptor. You invest, it's your problem. You can deal with it however you want to deal with it. The way Ann deals with it, I think he's like, that's great. Have at it, or don't invest.
Because by and large, no one's alleging, at least not on average, disclosure deficiencies.
Right.
It's not that people have bought something that they said, wait, you didn't. That's not the story.
Somebody's misled.
That's not the story. Yeah. So there's not a disclosure deficiency. Well, let's pause there. Maybe switch to questions from the audience.
But can I share with
yes,
them?
no,
that-
that's right.
okay.
Ann has
So as I was getting ready for this,
Exhibit
so
A,
actually, I don't know
think.
if any of you've read this book called The Match King about Ivar Kruger, who was sort of a Charles Ponzi of his day. This is the guy who actually invented the dual class share as he was trying to keep control of his match company back in the 1920s and the 19-teens. So I compliment your friends in Silicon Valley who are structuring their companies based on someone who is a bit of a questionable background. But that is the person who thought up the dual class share, the unequal voting rights for the different share classes in order to continue to maintain control of a share. He issued B shares with 1/1000th voting right as opposed to the one he had.
Now, if Scott Cooper were here, he would say tools are neutral. The people that use them might be good or bad. But
He was,
yeah.
yes.
Anyway, so thanks. We hadn't known
did
that.
have
I
a
didn't know that
chuckle
ahead of time.
about
That's
that.
great. So we have plenty more questions to talk about, but I think it's fair to turn it over and allow people to ask some questions. If you have a question, come on up to the microphone. If you don't, I have lots of backup questions.
I wonder on the opposite. It seems to me, but one, I don't understand your indexing, so that's something I've got to put off the table. If you were free to invest, why don't you both believe in the market and say these laws, any sort of regulations should be caveat emptor, and that market price is the value of the stock, and you believe in that, and it's up to tort law between contracting people rather than any sort of SEC or index requirements, et cetera, and just say, this is the corporation, change their mind and do what they want.
Let's maybe take some different answers at it. Is the market, if the market's efficient, why don't we just let the market work it out, right? What do you, Ann, I know you have an answer. Maybe we take a couple steps at that.
Well, I guess it's in the abstract, we could do that. I can't ignore the index for me because that is how we have made the decision to invest. And so and I don't make the decision of who gets in that, MSCI or Russell, whatever index you use makes the decision to do that. We have approached the index providers about, how do they set the standards for what should be in? At what point do they decide this is too much and it's not a best practice in the marketplace? And so we continue to have those discussions. But I am a believer in the marketplace. There are many in my world, in the shareholder world, who on any given issue, including dual class, would love to march to the SEC or to the Delaware legislature or Delaware corporate law section and have them legislate. I'm a believer that we take control as a shareholder. I have an obligation to advocate at companies that we belong in, what are good practices, what we don't, what governance we like or don't like of them. And I'm not sure I'd want to depend on Congress to solve these problems for us. So I'm a believer. Yeah.
And if you want to buy a stock, now I agree your index, that's a problem. But if you want to buy a stock and it's high value, it's going up, fine. But don't micromanage the company if they don't want to be micromanaged. If you don't want to buy that, fine.
Right.
It should be not. There should be no Congress, no SEC, no Delaware laws, except tort.
That deserves a whole different seminar.
I would
think.
disagree on that because our securities laws, and I would defer to the former commissioner, the SEC commissioner over there, are based on, and I think Jack said, disclosure laws. You know, what are the rules so I know what I'm buying and what the fundamentals. And I think as a result of individuals like this is the reasons that we have some of the 33 and the 34 Act securities laws in this country. These are the lawyers.
Yeah, Tad, do you mind weighing in a little?
I mean, look,
Again, how far does the market get us in terms of?
Yeah, I mean, and look, the answer is right now the SEC and Delaware largely stay out of it, right? I mean, they really do. They don't really impose any requirements other than, as everyone's saying, full disclosure. And if you're engaging in shady transactions, they may be looked at from a tort or other, similar legal, rubric. And I think that's largely where we are. Now, I will say that I think as an investor, Anne has every right to go talk to her companies, whether or whatever their structure is, she has every right to go talk to them about it. And I think it's having some impact. Like I said, I think, when I see this for IPOs of, companies that maybe aren't Facebook, most of those companies are not coming out with dual class structures, even when that conversation was had. And I think a large reason for that is because Anne and her colleagues in the field have been successful in talking to the various companies and railing on some of them during road shows. And investors are hearing that, and companies are hearing that, and bankers are hearing that. And so I think, to me, the model is probably working out okay. It's a more interesting question to me of, if you were looking back and you weren't an index fund, ought you be investing in these kinds of companies? And I think these studies are very interesting. I mean, the studies are tough because in recent years it really has been kind of the hotter companies that have, so you have kind of an odd sampling. And would that last? If everyone took that approach to investing, would that change? But whether or not you ought to invest in these companies, sitting in the boardroom of a lot of these companies, more companies that are honestly not dual class, but that just have a majority holder or maybe holders, the reality is they spend a lot less attention to corporate governance issues than companies that are not majority owned. And the answer is they don't worry about their ISS score in the same way that the directors of a non-controlled corporation do. In a non-controlled corporation, every proxy season, right now, I am talking to every one of my boards, and they are all very nervous about, is ISS going to be mad at us? Am I going to get a negative vote? I don't want that. What can we do? I will tell you that in a controlled corporation context, there is not 1 second spent on that because no one cares. Because the answer is when the founder votes his or her or its shares, it's all done.
But it isn't even a truly controlled. It can be somebody who has 30% or 25%, that can effectively control, or have a relationship with enough outside managers that they'll vote their shares like they are. And for a large fund like ours that has had some interactions with some companies there's one that's lost their say on pay vote for 5 years in a row by huge amounts. And it's like, we don't care. Well, at some point, the directors are going to start getting no votes. The shareholders are going to need the outside independent shareholders will at some point have a mechanism to express their frustration with if changes are not made in some regards. And there were some changes on the margins this year.
Question.
I have a question because I'm from China. I'm very used to that controlled corporations. So for the United States, I've seen you have those very complete legal system, such as the fiduciary duty and shareholder litigation and those market reputation. So don't you think it's actually these are the weapons to fight against this dual class share and the controlled? Will this help solve your investors' concern that the management will do bad things to the corporation? And then the second question is because you will never get rid of the controlled corporation. It's just a market. So if you're actually in this not perfect world, what other protection you need to fight against those dual class share?
Well, I guess what I would say is we do depend on the corporate governance, the fiduciary duty, and I think that's why it still is a very relatively small number, although it may be increasing. I think if you isolated it, it's to many technology companies, it's certain sectors that are doing this. So I would say those protections are helping us. We do have this one sector because of, and I think it's sort of the aura around the technology industry and some of their funders and some of the folks here in the Valley that have pushed this. But it is sort of the law and the structure in this country that has enabled an investor like me to talk to these companies about why we feel that this is not the best practice. And it is a cultural issue. I think because we're invested in emerging markets, and we see in India, Korea, we talked about these in terms of the controlled corporation, the cross-share ownership in Japan, but we're beginning to see changes in their corporate governance culture as they're beginning to, if they want to attract more capital to their markets, because global investors, will underweight Japan because some of the issues on the governance there causes us concern. So I think you're beginning to see, do they have to adopt the American? No, but they have to adopt a structure that from a governance perspective, global investors understand what their rights are, what they're getting, and have some expectations on best standards or best practices.
And I actually think it's an interesting question because, to Jack's point, there are legal rubrics in place, fiduciary duty rules, these sorts of things, and they're very useful in the context of certain transactions. A sale of the company where the founder has an interest, some other transaction where an interested party has an economic interest, and you fall into entire fairness. But short of that, the reality is that in the boardroom of a Delaware corporation, the business judgment rule governs. And you don't see a lot of business judgment rule litigation, right? I mean, the plaintiff's bar is not interested in litigating in Delaware over whether or not the board, satisfied the business judgment rule. It's not time well spent. Yeah. And so I think outside of significant transactions, you're not seeing as much on the litigation side, and I think that's part of the problem for Ann. Now, I will tell you, in recent years, I have seen, even with controlled companies where it's economic majority ownership, I have seen some shareholders get relatively aggressive and at least hire Delaware counsel to write letters about, corporate waste and these sorts of things. At least it's really to get their attention. And I think, so to your point, I mean, there's more of that here than probably in most jurisdictions. I represent companies that are incorporated in Bermuda or Singapore or the Caymans, and you certainly aren't seeing a lot of litigation around those. Candidly, even in the sale context, the plaintiff's bar in Delaware, they may step into a California corporation being sold situation. They get a lot edgier if they have to go figure out some foreign law. So, I mean, I think to your point, there's some protections, but it's not perfect.
Before we go to our last question, can I ask a quick follow-up? Is there, and this is almost blasphemous, is there the risk that this is a bit of a tempest in a teapot by the numbers? I mean, just by the total impact to corporations and the market force that seems to be causing, but it sounds like most of Tad's clients ask about it, but most of them end up not going down that path, not because they didn't want it, but because the market's not going to bear it, and it seems to be equilibrating at a level that you saw some growth, but maybe we want in the future. Is it a tempest in a teapot? And then we'll go to this last question.
Well, that might be overstating it. I mean, look, it's not the biggest corporate governance issue out there from my perspective, and probably not from Ann's perspective. But if I'm Ann, I'm going to address it. Right? If there's 114 companies out of the S&P 1500, it's not nothing. And so I certainly would be having the conversations about it. But like I said, I don't think it's the biggest issue out there. And I do, outside of Ann's index problem, I do generally think that if you're an investor and you know what you're getting into, you get into it. You may have, I don't see any reason not to have the conversations, and if the company's not performing, to go after them aggressively as a stockholder. But no, I don't think it's your biggest issue out there.
It could be. What we don't want it to go beyond, if it is a tempest, that it becomes a de facto practice, and that's why we stay on top of this issue.
And for the record, I don't think it's a tempest in a teapot. So last question.
As an independent director of several Delaware corporations, both private and public, none of which are no public dual control, I have a fiduciary duty to all the shareholders. So I've been thinking, is my duty proportional to their shareholding or proportional to their votes? And is there any either regulation or legal precedent that gives direction on that? Thank you.
Yeah, the last question is for Jack.
That's a Jack question.
That's a Delaware.
It is not proportional to the votes, isn't proportional to the shares. The duty is to make your own independent judgment in good faith, as informed as it is possible to be, that whatever decision you make as an independent director is in the best interest of the company. And that decision can't be delegated. That is, even if a majority of the stock wants to go the other way, you will not violate your fiduciary duty if you decide not to go that way, as long as it is a bona fide business judgment.
And that sounds like a good point to end the session on. Help me thank the panel for their time. Thanks very much.